Hey, Puppy Trades! Before I make this full screen, I want to tell you guys that this is the second take of this video. The first take of this video, I started with playing this song by Camila Cabello, Pharrell Williams, and Young Thug. I'm sure you're all very familiar with it. It goes, Havana, ooh na na. Half of my heart is in Havana, ooh na na. He took me back to East Atlanta, ooh na na. Right? So you guys know that song. The reason I was going to play that song is because I've been hearing Joanna, ooh na na. Half of my heart is with Joanna, ooh na na. For a bit. Because, you know, I really do have a little bit of beef with FinTwit. To be honest, you know, FinTwit, they're kind of ableist. Yeah, they kind of say that I'm crazy. That I got a mental illness or whatever. And that I'm too, you know, I'm crazy. You're crazy, pup. I always hear that. And so, you know, that's why I do kind of sadistic things like, you know, talk about gematria and my worldview, you know, during super cycle lows. Right? So anyone who thinks I'm crazy, you know, they're on the wrong side of that, right? Anyway. Yeah, they're right. I am a little nuts. Someone was like, "Oh, pup, I wish I bought Nvidia when you posted it right here." And I was like, well, it was probably between two posts about, you know, Pele being sacrificed and Kobe Bryant being sacrificed that you didn't like. And I put those there for a reason. I put those there for a reason. Because I have actually never experienced discrimination before until I started looking into this crazy thing people were talking about. I didn't realize it, but like to me, crazy has always been like a funny thing. Like, oh, like you're crazy, like bruh, right? And if someone actually did have a very serious mental illness, I'd be like, holy crap, we need to help this person, you know? And so a lot of people in my life, and Finchwood especially, they're not like Joanna and Jason. And many of you guys who have stuck around for so long, through thick and thin, you've heard all the jeers, but you just know I'm the best. You know it, and you're right. I am the best. And if you're really smart, you know that you want me to be talking about Taylor Swift, Ripple, Japan, and what Japan's foreign ministers said about a megaquake. If you're really smart, you're probably saying, Pump, when's that video? So if you guys want that video, give this 20 likes. Give this 20 likes, I'll give you that video. This YouTube link gets 20 likes, I'll give you that video. Because the smart pups know that's what I should be talking about. Joanna came to this page at a very interesting time. You know like how in Fight Club, they keep saying you came to my page at an interesting time before the financial system collapses, all the credit card buildings fall down. We're a generation of men raised by women. And my mother, She's very good at math, very good at data science, and she grew up very poor. So I'm someone who my whole life, because I'm kind of zany, I'm a little different. People don't want to give me the rewards and the awards that I'm rightfully deserved. That's why I have beef with Finchwick. I'm clearly the best. There is a market for people who are predicting the future of the stock market. They do have hundreds of thousands of followers at some points. They've got over 50,000 followers, over 80,000 followers. No one is better than me at predicting the future of the stock market. That is not my opinion. That is not grandiosity. That is just objective fact. In fact, I'm so confident in that statement that I have actually reserved some of my best predictions to be NFTs for what I am foreseeing in the future of the financial system. And I have made it to where it is not legal for X or any entity to mint any of my posts as an NFT, because I'm very aware of where this is all going. And some of these posts are very specially for certain followers. Okay? So, and by the way, there's a lot more important things than that. All right? You should know by now what I think of regional management and what I think of Camping World. I'm very prepared for bull market rallies in Camping World and regional management. I am very aware of the future subdivision of Regional Management Corporation, and I am much more prepared for it than anyone else to give you guys some of my stock market analysis. So Joanna, she came to me in my page at an interesting time because I had already proven myself to be the best, not only the best technical analyst on Finchwick, the best quant, because quantitative analytics became a big thing during the 2022 correction. And I had always wanted, I hated corporate America so much. There was just like this small, like 2 week correction, and I was in like this office job, doing operations, and I was being treated like such an animal. I started Googling straddles. Oh man. So yeah, about I studied straddles for so long, and I was always buying long straddles, long strangles, and I knew, I basically got the formula down. You can see, all these different ones. But I had a very specific process for screening for straddles. They had to be in a certain price range. Their implied volatility ranking percentile had to be perfect. They had to be on the right screen, and they had to be sold at the perfect time. Okay, all those things had to be true. So every single time I was making a straddle, I knew in the back of my mind I really wanted to be here on the short strangle and the short straddle screen. That's where I wanted to be. I knew that. Because I knew how much work went in. It took me years to figure out the exact straddle and strangle formula. It is extremely specific to the point where I wrote down the Greeks and I developed something called the gamma to theta ratio. It's extremely specific. And if it's not perfect, like, it's gonna blow up. You will lose money. That's not investment advice, but like, you will lose money. You will get effed. The straddle and the strangle has to be perfect or get wrecked. It has to be entered at the perfect time, sold at the perfect time, and all the signals have to be there. The stock even has to be in a certain price range. right? So I knew the perfect formula for straddle and strangle, and I also knew the whole time I wanted to be on the short strangle screen. So 816, sorry, is the last day that I will use straddles and strangles on the Metaverse ETF METV to hedge my portfolio. After that day, I will never buy options to hedge. That's kind of a crazy thing to say, but that's true. Why? Well, you guys were saying don't bring up religion, don't bring up religion, and I kept saying, but the dollar bill says in God we trust on it. It's got the pyramid with the eye on top of it. It's got all these Latin words. You know, our justice system is basically the sacrament of reconciliation, which was developed by St. Thomas Aquinas. Anyway, one of the religious principles is the Lord provides. Look at the birds in the trees, Anon. Do you see them worrying about what they're gonna eat? Where are their clothes? Are they planning their trips to the south and the north? Or are they just flying around and singing? They don't even seem concerned about what they're gonna eat, do they? Because the Lord's gonna provide. And what do you know? What do you know? At the exact moment of the stock market's local top, we get all these new short ETFs from YieldMax. And I realized very quickly that these were short strangle ETFs that could be blended potentially with other ETFs. So I am not going to be using the Metaverse ETF METV straddles and strangles to hedge for a crash anymore. I'm going to be buying, one of the biggest things I'm going to be buying is CRSH, Tesla's short ETF from YieldMax, blended with TSLP, Tesla's long ETF, both based on selling options by getting a synthetic position. What that means is for the long ETF, they buy a call at the money, they sell a put at the money. That gives them a delta of 100, and then they sell an out of the money covered call. For the short synthetic put ETFs, what they do is they buy a put, they sell a naked call, they buy a super far out of the money call to hedge it, and then they sell very short dated puts. That's what I love, because selling these short dated puts, they have the highest implied volatility in the world on Tesla, Coinbase, and Nvidia. It's not going to get more implied volatility than that unless it goes straight to penny land. Anyway, so I've been back testing this, and I found doesn't even really take much skill to make money with CRSH and TSLP, especially with the fact that now this is something where I don't really care if the stock market crashes. Just random periods in the first 83 days of TSLP. Sorry, this is TSLP. I'm using, so it did not work with TSLY. Okay, it works with TSLP and CRSH, but past performance does not indicate future results. Okay, but here are the results. Blindly for 83 days, averaging into both of them, a 14% annualized return. 60K turns into 61,940. That's a 14% annualized return. For 87 days, we get 60K turning into 62,203 from 5.3 to 8.3. That's a 15.43%. That's a lot. That's a good return. That's like one of the best years for the stock market, is that it's going to return 15.43%. And you're telling me some random person goes delta neutral in the CRSH and TSLP and makes that? Get out of here. Right? And that's why you're watching this right now. Because I didn't want some bums who thought because I was crazy, who had this worldview that anyone that was mildly mentally ill, you know, like, and this is bigger than what I've also been working on. I've also not only realized, hey, CRSH and TSLP, there's not a time frame where them blended together don't make money, and pretty good money, 10 to 15%. So far, that's called a short strangle. Will there be periods where a short strangle on Tesla don't make money? Of course. Over time, though, it looks like there's going to be some periods to take out 15 to 14% annualized returns on delta neutral trades that I can scale into infinitely and not be picking a direction and not be carrying the market's going to crash. Buy as much FEPI and YMAG as I want. I'm even running, I don't even have the dividends for Nvidia or Coinbases yet, but that's not stopping me. I'm getting these estimates very reasonably because of the option skew. It's almost always expected, unless it's a super bull rally, that the put seller is going to make more premium than the call seller. Almost always because of the skew. That's a very common option principle. You're not going to find that debated many places, okay? So I said, so basically the implication of that means DIPS over time, unless Nvidia is always in a crazy bull, and FIAT for Coinbase, unless Coinbase is always in a crazy bull, I expect them to have higher yields in a neutral market than the call versions of those ETFs because of something called the option skew. So the whole reason I say that is that when I say that I've given something where dips, the Nvidia short ETF has a 50% yield during a crash scenario like we just had, that's very generous, right? Because NVDY was yielding 100% during a bull market. Even during a bad period for NVDY, the yield was 65%. So over time, the average yield for dips is probably not going to be 50%, but I quoted 50% as the dividend yield if that dividend yield was added. And the reason that I quoted a lower number is because the objectors are going to say that there's going to be a dividend drop. Okay, so I believe if the options are out of the money, they expire out of the money, their premium does not affect my net asset value. If the options did expire in the money and the shares were called away, that premium does come out of my net asset value during the dividend drop. But if a stock's in a super bull market to where that's always happening, implied volatility is going to take that into account. So anyway, a lot of option studying going into this. Nvidia, potentially with a 50% yield, has a 1.76% return when it's blindly averaged into over the course of just, 14 days, very short sample size. But that's a 50% yield. It's very low, and that would have actually been a 1.767% return in 14 days, blindly averaging into those two, which is actually a 46% annualized return. So anyway, that's just what I'm working on. CRSH and TSLP, and I'm doing it for Fiat and CONY right now. These are going to be the ways, in addition to diversification into bonds and bond buy right ETFs that now have positive total returns when they're blindly averaged into, in addition to lots of inflation hedges like BCX and RQI, those closed-end funds that I talk about, diversification, and now direct downside exposure to Nvidia, Tesla, and Coinbase. I'm going to use long common positions that pay dividends to manage crash risk, not long gamma positions that cost premium. So let's get into some of these stocks. Now that I've gotten that out of the way, URA, I think about you every night and day. Wave 1, ABC. Wave 2, Wave 3, highest high on the RSI. Shallow Wave 4, and a Wave 5 that ends with Momo. We have an ABC correction between the 61.8 to 78.6% retracement. And let me give you a little sugar. Let me give you a little sugar right here because what's going on here? IV low of 8.64% was reached on August 5th. Isn't that a little interesting? First off, let's look at August 5th. What was going on August 5th? We were having a huge crash in the entire, market, huge VIX spikes, and URA is dumping. URA is just absolutely dumping, but it hits 0% IV rank and 8% implied volatility. That means that they were saying this volatile uranium sector was only implied to move 8% over the next 52 weeks. Does that sound right? Because I'm pretty sure that's about like half of what SPY is, and I'm pretty sure it's significantly lower than what the Treasury bond ETFs is. But anyway, I took off my tinfoil hat. I put on my wool. I think this is a 1, 2, 3, 4, 5 waves impulse. High, very pretty. 1, 2, 3, 4, 5. Into the trained eye, look at this wave 3. Your smart eyes are going to be able to see. For the big wave 3, you're going to be able to see a 5-wave subdivision. Very clean here. 1, 2, 3, 4, 5. Lovely. Wave 3 subdivided into 5 waves. 4, 5 ends with Momo. ABC correction of the 61.8 to 78.6% retracement. There's only one thing to do, and that's to say 21.04 is invalidation stop. Wasn't supposed to be all caps, but hey, it's uranium. Might as well go big or go home, right? And by the way, this is where I'll remind smart people, not the smart people Ellen DeGeneres is talking about. Smart people, like you have a high IQ, you're gonna want to go like this video and say, hey pup, let me know what you think about Japan. Let me know what you think about Ripple. And let me know what you think about Swift. All right, let me know what you think about Japan, Ripple, and Swift. And some of those announcements that were made recently. Someone said Japan's not known for being alarmist or dramatic. So when Japan says something, I'm going to take it seriously. I'm not an expert in politics, but I think I'm going to do that. 21.04, if it holds, the length of wave 1 placed at the wave 2 low. Let's get a little more precise. Come on now. This is PT. Yes, that's fine, actually. The length of wave 1 placed at the wave 2 low. 38.72 can be hit for URA. I like it above 21.04. Let's just call it 21. Why not? And I like these small wave 2 lows, 20.32. That's a little far, but we'll do 21. 21.04. We'll do that. Tesla. My naked chart of Tesla. Here's my real chart of Tesla. This is my real chart of Tesla. This is the real chart. Blindly averaging into TSLP, 21% annualized return. Blindly averaging into CRSH. What's going on here? Tesla's got a lot of implied volatility. It's got a very liquid options market. No snap. It's got positive total returns. Selling options, delta neutral through ETFs. Not TSLY though, only TSLP. That's very interesting to me because that could actually make Tesla a very special stock because Nvidia doesn't have a curve ETF and neither does Coinbase. So anyway, I actually do think, just my analysis, I think one of them, Coinbase and Nvidia, delta neutral is going to be a positive endeavor from a new position, okay? What I want you guys to know, and I think I made this clear, hopefully I made this clear, I have pre-existing positions in Tesla. I bought Tesla and TSLY. I blended them together right here. I collected these dividends. I didn't reinvest any of the dividends into Tesla and Tesla. I invested them into other assets. So I use that as an asset accumulator. Nvidia, I bought a huge NVDY lump sum position around this time right here. So yeah, that one worked out. So that's a huge winner. It's already paid for itself in dividends. That's why I'm considering dips and NVDY together, even with preliminary back testing, because it's going to hedge a pre-existing position that's already a huge winner. It's already paid for itself in option premiums. It can't lose money. It's already paid me back. So Coinbase, same thing right here. You guys were along for this one. Big position in Coinbase, blended with CONY, right around the IPO. Bang, bang. Okay, so you know, crazy is as crazy does, I guess. But anyway, I think I've made it clear, you know, why I do what I do. Looking at Coinbase right now, ABC, very clear. 1, 2, very clear. The debate now is this 1, 2, 3, 4, 5? And it's a large wave 3? Or is this ABC correction? This deep, dramatic ABC correction at the 50% fib? Is it another wave 1 and another wave 2? The truth is... Wait, what's the truth? The truth is... maybe bulls won't care. The fiat and CONY back tests were very interesting, but I am going to wait to see a dividend on that one. Maybe the answer is don't. And so if Coinbase and CONY and fiat blended together are positive, why is that such a big deal? Because Coinbase is heavily correlated with Bitcoin and is heavily correlated with BICO and MSTY, which also pay big dividends. So it could hedge a lot of the crypto bucket. Let's look at Coinbase. 1, 2, 1, 2, 3, 4, 5. Is it a wave 3 and an ABC wave 4? Or is it a wave 1 and an ABC wave 2? For a lot of these, this low of 161.13, that's going to be the tight level. Way too far, 136.98 is going to be the wide invalidation. So why am I going to say 161.13 is the stop? Well, this is the 50% fib. When a correction ends at exactly the 50% fib, it's very difficult to distinguish if it is a wave 4 correction or a wave 2 correction. So wave 4s typically are more triangle based, but this is Coinbase. It's very volatile. The distinction right now, to be honest, is irrelevant. The downside levels are the same. What I will say, though, if Coinbase did break 161.13 and go down to 136.98, hit that 61.8% fib, that would be definitely that this is a red wave 1, this is a red wave 2, this is a wave 3 of wave 3 in progress. I'm looking for Coinbase to hold 161.13. I have a position in CONY that's already paid for itself. I made a 240% return on Coinbase Commons that I shared with CONY before it paid for itself, and I took profits on that. So now I'm back testing CONY blended with fiat. So I keep adding to this position, keep adding CONY, and if Coinbase falls through the roof, I'll have dips to cushion me and the rest of my crypto position. If things get crazy, Coinbase wave 3 places the wave 4 low, is that wave 5 target, up and away into the upper 300s, possibly for Tesla. I look at Tesla. 1, 2, 3, 4, 5, wave 1, ABC wave 2. Zooming into the daily. This is my untouched chart. I wanted you guys to see it. Wave 1, wave 2. Look at that. We go right up there to the 161.8% extension. Bang. We have an ABC correction. I did predict we'd have a correction after that. It was a little deeper than what would normally be called a wave 4 correction, especially with it breaking the wave 1 high. So I've built up my CRSH TSLP position, and I'm going to keep building that, but I am biased to the upside. And so this is kind of where I wanted to get back to what I was saying earlier, is we're moving to a place on this page where my technical analysis is going to matter less and less than my quantitative analysis, and that's a very good thing. So I like 182 tight. I know that's picked the low, but I'll justify that real quick. It's picked the low at the 78.6% retracement. That's a good pick the low. And then the invalidation is very clear. The invalidation is 167.14. And then the length of wave 1, place of the wave too low. It's kind of bizarre. We'll see what the fundamental explanation is going to be. The length of wave 1, place of the wave too low, can take Tesla up to 286 before a shallow wave 4 and a wave 5 higher. Realistically, it can go a lot further than that. You have wave 4 retest the wave 1 high. Wave 5 is at least the length of wave 1, place of the wave 4 low. That can take Tesla to the upper 300s. Another way to find a wave 3 target, the length of wave 1, place of the wave 2 low. That 127.2% extension, 314-ish. Shallow wave 4. Wave 5 higher. And so for, yeah, that looks pretty. I like that. And then last one, we'll do Nvidia. Just absolutely perfect. Large wave 1 and wave 2. I think this was 1, 2, 3, 4, 5 from the low, just like I predicted. On the weekly, 1, 2, 3, 4, 5 waves, ends with momentum divergence, where wave 3 makes the highest high on the RSI. You'll notice on the monthly, though, this is still the highest high, and that's because it's a larger degree wave 3 before a shallow wave 4 and a wave 5 higher. 90.69, that's pick the low, and it's really the only level right now. So that's why I'm looking into protecting Nvidia and NVDY and CONY gains by back testing delta neutral positions in NVDY, dips, fiat, and CONY. We look at Nvidia though. What's this wave 5 target gonna be? Well, if it's the length of wave 1, place at the wave 2 low, wave 5 doesn't make a new high. So if it's the length of wave 3, place at the wave 4 low, You can go 222 heck if you think I'm going to say that number out loud.